Hey guys, it's Carter. Welcome back to the channel. Hope you guys are all having a great and amazing day today. In today's video, we're going to be talking about Lyft and answering that main question of should you buy this company. As of today, the stock has fallen 37% after the company came out and a whole bunch of analysts downgraded the company, and the company came out and gave a weak guidance for the first quarter of 2023. So guys, what's going on inside this company here? So looking at it, if we go today, you'll notice the stock has gone from about $16 all the way down to about $10. Now for me, I always think, okay, when a stock like this falls, you can really have two mindsets. The first mindset is, all right, this thing fell 36%. This is a massive opportunity to buy in at a more affordable price. Now, for me, I always think, all right, if we see some sort of potential, what does potential mean? Potential means good margins, good free cash. It means good revenue increases. Stuff like that is a strong indication that the company will eventually bounce back. Also, what's very, very important is looking at the company as a whole. So looking at, the yearly chart here, you'll notice the stock has gone from $70 all the way to $9. We've had this downward trend, and the volatility on this thing is very, very high. The stock goes from 20 to 70, back down to 9, back up to 17. So the volatility is very, very large. Now, anytime you have increased volatility, that is higher risk. Often you'll have high risk, high reward. So for me, Lyft, right now we've seen this opportunity to possibly buy in at a more affordable price, but I'm not interested in that. I care about these fundamentals. Right now, Lyft's fundamentals are not the greatest. They have a negative 32% profit margin. What that means is for every $100 Lyft brings in, they lose $32, which you can't grow and sustain a business if you have a negative profit margin. They're supposed to be working on their profits and their profit margin when they increased their prices over the past couple of years, because I think we all know Uber, Lyft, all these ride-sharing apps had their prices increased to adjust for inflation and to eventually make these companies become profitable, because they're not. Very, very rare do you have a company in a startup like this that is profitable. I can't even think of any. Uber is not profitable. Postmates, DoorDash, they're all not profitable. So now, downward trend. Anytime you have a downward trend, sellers are in control. Not looking good. Another very important thing when evaluating a company is something called the cash on hand. So this is all the cash they have. They do have a decent amount of cash at about $1.7 billion, comparing to their long-term debt, which is about $800 million. So they do have quite a bit of debt. They have more cash on hand, which is always a good sign. But another thing I think we always have to look at is competitors. Right now, Uber, if we go ahead and we pull up this company, you'll notice it's still on this downward trend. So right now, the sector as a whole, for me, is not the greatest investment. There's too much competition in this space. If we also pull up DoorDash, which is another one, I'm sure we'll see the exact same thing, probably just a downward trend. So the sector as a whole is not the greatest investment. I just think there's better opportunity elsewhere to put your money. Not to mention, we've seen this thing sell off 40%. There's no strong indication or, a very strong revenue or something to give me a little sign of life for this company. Now, yes, there will most likely be one of these companies that will stick around and be a fantastic pick. So for me, it's a high risk, high reward play. I'm not investing in it. I don't see an opportunity. I would rather put my money in Tesla, Google. OpenAI right now is absolutely going crazy. We see so much opportunity in the market, and putting your money in DoorDash or Uber or Lyft, just for me, is a waste of money just to have depreciate. I'm not looking at it, and there is an article right here on CNBC, really just explaining kind of what I just stated. The ride-sharing app pretty much catered 36% after disappointing guidance in its first quarter. It also got hit by a few downgrades by analysts. And they do say Uber right now is in a better position to capitalize the market, but even Uber, Uber has a little better profit margin at 29% comparing to Lyft, which is at 32%. But the thing is Uber has $9 billion in debt. That's so much debt, and they only have $5 billion in cash. So they have $4 billion in negative assets, which is terrible, plus a terrible profit margin. So for me, I'm not investing in any of these. I just don't see them as a strong opportunity to make money, guys. So hope you guys enjoyed it. Hope you guys learned something. If you have any questions, let me know. But we'll see you guys later. We'll see you probably in another episode later today, guys. And don't forget to check out my vlog channel where you guys can stay up to date on what I pretty much do daily. So check that out. We'll see you guys later. Take care, everyone.